If you still believe that the only way to make serious money in the stock market is to buy expensive blue-chip giants, then February 2026 might be the month that proves you wrong. Most investors are trained to think small stocks are too risky, too unstable, and too unpredictable. Under $1? That sounds like gambling. That sounds like desperation. That sounds like companies on life support. But what if some of the biggest shifts in artificial intelligence, in energy infrastructure, and advanced manufacturing are quietly depending on companies most people have never heard of? And what if a few of those companies are still trading for less than a single dollar per share? Right now, the world is racing toward an AI-powered future. Data centers are expanding. Governments are investing billions into domestic infrastructure. Electric grids are under pressure. Supply chains are being reshaped. And every one of these massive transitions depends on something very simple: physical infrastructure. Not software, not social media, not apps. Real physical systems, power, connectivity, components, materials. Here's the hidden problem almost no one talks about. Artificial intelligence is not just code. It is electricity. It is cooling. It is advanced hardware. It is precision components. Every new AI model requires enormous computational power. Every new data center requires energy density and reliability that older grids were never designed to handle. And the United States is not fully prepared. Power demand from AI and data centers has surged faster than expected. Utilities are struggling to modernize transmission lines. Rural broadband expansion is incomplete. Semiconductor manufacturing capacity is still being rebuilt domestically after years of outsourcing. The headlines focus on trillion-dollar tech giants, but behind the scenes, there's a bottleneck forming: infrastructure. Traditional solutions are failing because they were built for a slower world. Old grids weren't designed for AI clusters that consume as much electricity as small cities. Legacy manufacturers can't instantly scale precision components. And global supply chains are fragile, especially when geopolitical tensions disrupt shipping routes and critical materials. That's why a new category of companies is emerging: small, specialized, infrastructure-focused firms that operate quietly behind the scenes. They don't have flashy brands. They don't have massive marketing budgets, but they solve highly specific, mission-critical problems. And in many cases, they are still trading under $1 per share. Today, we're looking at some of the best penny stocks under $1 right now for February 2026. Not lottery tickets, not meme stocks, but small companies tied directly to major structural trends. Let's begin with a company operating in the power and energy infrastructure space: Camber Energy. Camber Energy trades under $1 and operates in the energy sector, focusing on technologies that improve efficiency and emissions control. On the surface, it looks like just another small energy company. But the real story is about the transition period we're living through. The world is not flipping from fossil fuels to renewables overnight. Instead, we are entering a hybrid era. AI data centers need stable, always-on power. Renewable sources like wind and solar are growing, but they are intermittent. That means grid stability is becoming more important than ever. Camber Energy is involved in technologies that aim to optimize energy usage and reduce emissions from existing infrastructure. In simple terms, instead of tearing down the old system completely, they focus on making it cleaner and more efficient. Why does that matter now? Because governments are pushing aggressive emissions targets while still demanding reliable energy. Data center expansion driven by AI is forcing utilities to rethink power generation. There's growing pressure to modernize without disrupting supply. Financially, Camber Energy is still a small-cap company with limited revenue compared to industry giants. Revenue growth has been uneven. Cash position is something investors must monitor carefully. Like many penny stocks, it has experienced volatility, share dilution, and significant price swings. This is not a stable dividend payer. It is a speculative infrastructure play. The risk is real: execution risk, funding risk, market competition. If capital markets tighten, small companies can struggle to raise funds. But the catalyst is also real: energy modernization, AI-driven electricity demand, and policy incentives for cleaner infrastructure are long-term trends. If Camber successfully positions its technologies within this transition, even modest contract wins could materially impact its valuation due to its small size. Now let's shift to a different bottleneck: digital connectivity and rural infrastructure. The AI revolution does not stop at data centers. It extends into smart agriculture, remote healthcare, edge computing, and autonomous logistics. All of these require reliable broadband and communication networks, yet millions of Americans still lack high-speed connectivity. That gap is not just an inconvenience. It is an economic disadvantage. A company operating in this niche is Borks Technologies. Borks Technologies focuses on IoT solutions and connected devices. In simple language, they build and enable smart devices that communicate through networks. Think industrial sensors, connected machines, and smart infrastructure components. Traditional telecom giants focus on large urban deployments. Smaller firms like Borks aim to fill specialized niches. particularly in industrial IoT and customized solutions. Why is this happening now? Government funding. Over the past few years, billions of dollars have been allocated toward broadband expansion and digital infrastructure upgrades. Smart cities, smart grids, and connected industrial systems are no longer futuristic concepts. They are budget line items. Borks is still a small company. Revenue levels are modest. Profitability is uncertain. Cash burn is a real concern. Competition in IoT is intense. This is not a guaranteed winner. But if even a handful of large contracts materialize in government-backed infrastructure programs, the impact on such a small market cap company could be substantial. Under $1, the stock reflects skepticism. The opportunity lies in whether execution matches the macro trend. Now let's examine another structural issue most investors ignore: advanced manufacturing capacity inside the United States. The semiconductor shortage of the early 2020s exposed a vulnerability. Chips power everything from AI servers to electric vehicles. Governments responded with massive funding packages to rebuild domestic manufacturing. But semiconductor production is not just about chips. It involves specialty materials, components, coatings, and precision engineering. One company in this broader ecosystem trading under $1 is AXT Inc. AXT Inc. manufactures specialty semiconductor substrates. In very simple terms, these are foundational materials used to build certain types of chips. Without the right substrate, the chip cannot function properly. Why is this important? Because advanced AI systems rely on high-performance chips, and those chips require specialized materials. As demand for AI hardware increases, the supply chain behind those chips becomes more valuable. AXT operates in a competitive industry. Revenue fluctuates with semiconductor cycles. The company faces pricing pressure and global competition, particularly from Asia. Financially, investors need to look at revenue trends, gross margins, and balance sheet strength. Cyclical downturns in semiconductors can hurt smaller suppliers, but timing matters. The semiconductor industry is historically cyclical. Down cycles often create opportunities if long-term demand remains intact. With AI demand projected to grow for years, suppliers that survive downturns can benefit when capital spending rebounds. The risk here is clear. If AI spending slows or if larger competitors squeeze margins, small suppliers can struggle. The upside, being part of a structural government-supported reshoring effort tied directly to AI infrastructure. Another area gaining momentum in 2026 is battery storage and grid modernization. Renewable energy growth is accelerating, but storing energy efficiently remains a challenge. Grid instability has become a serious concern in certain states due to extreme weather and rising electricity demand. Small-cap companies in battery technology and storage systems have drawn investor attention. One such name trading under $1 is EOS Energy Enterprises. EOS Energy focuses on zinc-based battery storage systems designed for grid-scale applications. In plain English, they build large batteries meant to store electricity for later use. Why does that matter? Because renewable energy does not produce power constantly. When the sun sets or the wind slows, stored energy must fill the gap. AI-driven electricity demand adds another layer of urgency. Data centers cannot afford blackouts. EOS has faced operational challenges in the past. Production scaling has been difficult. Financial losses have been significant. Investors must carefully examine cash, runway, and debt obligations. This is not a risk-free story. However, government incentives for domestic battery manufacturing and grid resilience programs create potential tailwinds. Large-scale contracts with utilities or government agencies could dramatically shift the company's outlook. As a penny stock, volatility is extreme. Price swings can be sharp in both directions. That brings us to an important reality check. Penny stocks under $1 are not safe investments. They often face limited liquidity, high volatility, and real financial constraints. Some will fail. Some will dilute shareholders. Some will never achieve profitability. But occasionally, one operates in the right sector at the right time with enough capital to survive until momentum shifts. February 2026 is an interesting moment. Artificial intelligence demand is reshaping power consumption. Governments are still pushing infrastructure spending. Semiconductor cycles are stabilizing after prior corrections. Energy storage remains a strategic priority. The macro environment is not guaranteed to remain favorable forever. Interest rates, policy shifts, or economic slowdowns could impact small-cap financing. That is why position sizing and risk management matter. For long-term investors willing to tolerate volatility, these under $1 stocks represent asymmetric bets. Limited downside relative to capital invested, but potentially meaningful upside if execution aligns with macro trends. None of these companies are trillion-dollar giants. They are small, imperfect, and exposed to real challenges. But they sit at the intersection of AI, infrastructure, energy, and domestic manufacturing. That intersection is where the next decade of economic growth is being built. The question is not whether these industries will grow, The question is, which companies survive long enough to participate in that growth? Camber Energy must prove it can turn technology into sustainable revenue. Borks. Technologies must demonstrate real contract wins. AXT must navigate semiconductor cycles while maintaining competitive positioning. EOS Energy must scale production without exhausting capital. Execution is everything. If they succeed, the percentage gains from sub-$1 levels could be significant. If they fail, losses could be substantial. This is the nature of penny stock investing. It is not about hype. It is about identifying structural trends early, understanding financial realities, and accepting uncertainty. As always, this is not financial advice. Every investor must conduct independent research, review financial filings, and understand personal risk tolerance. The biggest mistake investors make is assuming small means irrelevant. In infrastructure revolutions, small companies often play critical roles. February 2026 presents a rare combination of AI expansion, infrastructure funding, and supply chain realignment. Some of the companies positioned within that shift are still trading under $1. Whether they become tomorrow's breakout stories or cautionary tales depends on execution, capital discipline, and market conditions. If you found this deep dive helpful, take a moment to like the video, share it with someone interested in small cap opportunities, and subscribe for more realistic, research-driven market stories. The biggest opportunities often begin where most people are not looking.